This webinar is one of many tools and supports available online at cbrn.ca to support Canadian businesses' continuity efforts. This series and other tools are made possible by our valued CBRN partners, such as TD. The Senior Director of Tax and Financial Policy at the Canadian Chamber, moderator today. Good to see me. So allow me with great pleasure to introduce you to Dale Durand, Business Succession Advisor of Wealth Advisory Services at TD. During these extraordinary times, business owners and managers are faced with significant challenges. Dale is here to discuss with us how business owners and managers can increase their corporate and personal cash flow through tax planning strategies. A couple of housekeeping items before Dale begins his presentation. First, this session is meant to be interactive. Following Dale's presentation, you have an opportunity to raise a question live, either by clicking the hand button at the bottom of your screen, like this, or you can submit your questions by going to www.slido.do and entering the event code Z246. I'll then read the questions aloud. Secondly, this webinar is being recorded and will be shared on cbrn.ca later on for your viewing and perusal. And with that, it's my pleasure to turn things over to Dale. Dale, you may begin your presentation, and afterwards we'll follow with the Q&A moderated by me. Becca will advance the slides.
Thank you, Patrick. I certainly appreciate the kind introduction. It was much more flattering than someone who introduced me a few years ago as a useful tool. They were actually trying to be kind, but they just picked the wrong words, I guess. The objective today is not to turn you into CPAs in the next 30 minutes, but rather let you know what your fellow business people across the country are doing in these extraordinary times to bluntly make lemonade out of lemons. The entire objective is to attempt to put you in the know rather than not find out until it's too late to be able to deal with these items. So if you could advance the slide to 2 slides, please, that would be great. So why now? This slide that I'm looking at talks about the prime rate. Fundamental to some of the opportunities that we have today in the marketplace is simply that the interest rates are at historic low. Whether that be an opportunity for you to restructure existing debt at lower interest rates, possibly borrow for investment opportunities, or even to invest in yourself by arranging an operation whereby you might even be able to borrow money and dividend yourself some of the equity out of the company, because many banks are willing to do that for strong, healthy companies that might have a situation where cash flow doesn't allow for current owners to be able to live the way they should be. It's an opportunity that, and I should also remind everybody that these are not do-it-yourself strategies. These require the help of your lawyers, your accountants, and your financial advisors to achieve, but they are all reasonable activities, and every one of them have been a success in the past few months by owner-managers. So if I go to the next slide, please. Our point now on the next 2 slides really talk about the Tax Act, and I simply do this to give you some context about where we're going with the rest of this information. My first slide is on tax integration, and it's simply what it says is, the Tax Act is a complicated document, but what it tends to do is to say, no matter how you achieve your income, whether you get it personally as an employee would, or whether you're lucky enough to have it run through your own company owned by you and your family and out to yourself in the same year, the result is the exact same after-tax income in your hands. There might be pennies difference, there might be small percentage differences. The Tax Act requires that no matter which way we go, you get the same after-tax results. Now, what this does right away is just a misnomer that most people have, that a corporation in itself has a whole bag of deductions that a person does not have. Well, that's just patently false. Almost every single deduction available to an individual is available to a company and vice versa. So our point here is that if you need funds and you must take all of your income on an after-tax basis to support your lifestyle, it doesn't matter whether you go through a company or your own personal hands. But the opportunity and a gift from CRA is for an owner-manager who has the luxury of earning more profit than they need to spend in a given year. If they simply leave the unneeded profits behind in the company, they create what I call the corporate RSP, or more precisely, the tax deferred advantage. So we could go to the next slide, I'll illustrate this. I would also ask you at this point, and I'm going to do this a number of times, there's lots of information on the screens. You can read them as fast as I can read them to you. So I'm not going to do that. What I'm going to do is try to tell you a story that I think resonates with people and allows you to understand the principle a little bit better. So let me start with this story. If you're an owner manager, you own a company, you have $1 million worth of top line revenue. You take out a $250,000 salary to cover your own personal lifestyles, and you have an additional $250,000 of salaries for your other people, rents, supplies, whatever, leaving you with $500,000 of after-tax profits. Well, at this point, you have two choices. Your accountant will help you make these choices, but you essentially have two choices. You could take a $500,000 out as a giant bonus, leave no taxable income inside the company, but you would lose approximately 50% depending on what province you're in, because given that you've already taken a $250,000 salary, you're almost definitely in the highest tax bracket in any province in this country. And that necessarily means that you would lose half of this bonus that you do not need to live on. So you simply have $250,000 to put into a savings account. Or more normally, you leave it behind and pay the small business tax rates inside your company. Now, the slide I'm showing you is Ontario, but all provinces are in a similar ilk. The tax rate for the first $500,000 is somewhere between 12 and 15% at the small business rates in this country. So what simply means is, if you leave the money in the company, you now have approximately $250,000 more inside the company that would be money that would not necessarily be yours, but you get use of it as long as you keep it inside the company. That is the tax deferred advantage. You will lose the small business tax rate, 12 to 15%, but the rest can stay in the company and be used for anything you wish. It could be used for working capital, it could be used for investment, it could be used to simply save for your own retirement. I have literally sat down with hundreds of owner managers across the country in my career. And the one thing that has always struck me since these tax rules have come out in the late 70s, owner managers doing this properly with the tax deferred advantage in mind will have more saved up in their corporate structure than they will even have in their own RSP or retirement pension plan. It's a huge wealth, and it's something that you get to use any way you like. So let's go to the next slide now and look at sort of what that means. So the context was now we're building up this money, and that one example I just gave you was 1 year. You might be doing that for 5 to 10 to 20 years and building up all this capital inside the company. Well, recently, about 3 years ago, the federal government imposed rules on earning investment income inside of a corporation. I'm not here today to tell you about all those rules, but essentially what it is realized investment income this year in your corporation may have an effect on how much of your favorable small business tax rates you get to use and utilize next year. They give you the ability to recognize $50,000 of realized investment income this year with no penalty. But if you have $50,001 this year, that $1 reduces your $500,000 small business tax zone by $5. So what's the implication of that? Well, simply with the proper planning in place, an owner manager tries not to recognize unwanted investment income inside their corporation to be able to avoid this unpleasant tax result next year. If you end up with $150,000 in your corporate structure of realized investment income, and I say corporate structure because it could be any holding companies or any other companies, sister companies that are related to your operating company, it is all added up into one pool. And if you go over that and you get to $150,000 of realized investment income at a rate of 5 to 1, you'd lose all of your $500,000 small business tax rates. And depending on what province you live in, that would mean an extra $30,000 to $70,000 of income tax to be paid next year on the same income. Because if you do not have small business tax rates, you are paying tax at the same level as a public company, TD Bank, for example, at 26.5%. Now, the other part is we've got money in the company, and we are obviously going to earn some form of investment income on it. The vagaries of integration in most provinces means that it's not perfect. And in most provinces, these numbers you're looking at happen to be Ontario, but in most provinces, you would rather have realized investment income in your personal hands rather than in corporate hands, because by the time you take that realized corporate investment income out and pay all the taxes required, you would have paid more tax than if you'd earned it personally. But if you've got the money in your company built up from earnings, this makes it even more important to make sure your accountants and your financial advisors minimize unwanted investment income to avoid the clawback of the small business tax rates and to be allowing you to grow your money faster with a smaller tax drag on it. Next slide, please. So let's get into some of the strategies I've been promising. The first is triggering capital losses inside your corporation. So imagine that you have an investment portfolio built up of these tax-deferred dollars we keep talking about, and 2020 being the wretched year that it's been for everyone, has your portfolio decline in value. And you may have some losers in your portfolio. So here comes the second of my stories. Back in April, a good friend of mine who owns a company asked me, and I helped him with his compliance work. So his simple question was, how many gross capital gains have I earned and paid tax on in my prior 3 tax years? Well, we calculated the numbers. And then all he wanted to know is how much of a loss should he recognize this year in his now declining portfolio so that he could take back those losses and carry them back for all 3 of those years and recover all of those taxes paid on those passive capital gains done earlier. Now, there are issues that you have to worry about before I give you the numeric example here, and I'm going to talk more about the capital dividend account in a minute. And there is an issue you've got to be careful of when you're triggering losses there. We'll talk about that. The one is superficial loss rules. And all this simply means is if you sell a security, you must stay out of that position for 30 days. If you were to buy it right back within that 30-day period, it's as if that loss never happened and you don't get the advantage of what we're going to describe here in a moment. And also, if you don't have losses enough that you've already recognized in prior 3 years, it can be carried forward indefinitely and used whenever you do create capital gains in your portfolios in your corporate accounts in the future. So next slide, please. So here's the numeric example of my friend. We determined that he had, and these are gross numbers, created $260,000 worth of capital gains in the prior 3 years, 80, 60, and 120, as you can see on the screen. Now, only half of those were taxable, of course, which meant $130,000 was taxable, and which he paid an approximate 50% tax rate, which means he paid a total taxes of $65,000 over the prior 3 years on capital gains. In 2020, he was able to recognize $260,000 in capital losses And essentially all he cared about was, okay, at the end of my fiscal year, I'm going to get that $65,000. And that's going to be enough to get my money out of the company, to give my company enough money to give me what I need to live on for the next year and not have to touch my working capital. So it could be as simple as that, or simply as if you're going to recognize losses, you could carry them forward indefinitely and offset future taxes. But this is something that you need to do before the end of the year, and to make sure that it's done and actually set in your account properly to be able to net recognize losses to recover past gains. Next slide, please. Now, as promised, I want to talk about the capital dividend account for a couple of seconds, because this is a very, very interesting way for an owner manager to get tax-free money out of their company. The capital dividend account is simply a ledger that exists inside your corporate tax return and no place else. What's added to the ledger is the tax-free half of any capital gain recognized in that fiscal year. What is deducted from a ledger is the tax-free half of losses, capital losses recognized in that year. So at the end of the year, or any time during the year, if there is a positive balance, which means more gains than losses, that money may come out after your accountant files an election with CRA to you completely free of all corporate and personal taxes. I will also tell you that many owner managers now are doing this. They're looking at their companies and they realize the value of the company is a lot more and a lot bigger than when they originally started it. So they've got this giant goodwill value to increase the value of their company. Well, with the help of their accountants and lawyers, they are actually recognizing that gain, that goodwill, if you will. This is a complicated thing to do, but your accountants and lawyers can help you do it. And that too is a capital gain, and the tax-free half is money that can come out to you on a tax-free basis. It's also important to remember the ordering. I'll get to this in a little bit, but you can, in the same year, you could theoretically recognize gains, have a tax-free half and a taxable half, take the tax-free half out through the CDA, and before the year is done, recognize losses that would offset the taxes on the taxable half of the gain. And result is you could get some money out of your company in this manner and not pay any even corporate taxes this year. Next slide, please. It's also important to talk about estate freezes. Now, an estate freeze, for those of you who don't know, is the ability to freeze the current value of your company and pass that future growth of the company on, presumably, the next generation of your family. Someone who owns a corporate structure that they believe will increase in value in the future, has enough value currently to support them for the rest of their lives, and then and would want to pass the future growth off to the next generation, should consider an estate freeze. Now, the reason this is important is that when we pass away and we own shares of a company, it's as if with our dying breath we sell that company. And any unrealized gains are triggered in our terminal tax return. Well, if we can minimize that loss, that gain, I should say, meaning put a top on it, a cap, a roof on it today, and let the future growth go to the next generation, we will reduce the taxes we pay at death and make it easier for the family to continue the company on after our death. The other side of this is, and not all provinces are the same with this, like Alberta is not an example of this, but most provinces have probate fees. It's actually a tax on the fair market value of your estate. In many provinces, it's legal to have a secondary will, which is almost a carbon copy of your primary will, but this will covers all of the items that do not need to be probated. Items that do need to be probated are typically investment accounts, bank accounts in the name of an individual, that is, real estate in the name of an individual, like your principal residence or cottage, And those things need to be probated. That simply means that a judge says that this is your official last will. And by the way, it gives the authority for the executor and the trustees to carry out your will. But it also means that the clerk in that courtroom, when this is done, gets to collect a fee somewhere between 2 and 3%, 1 and 3%, depending on a province, of your assets. Now, that can be avoided as it relates to non-probatable assets, like shares of a private company. And they, in fact, could be covered by the secondary will, and the only person who needs to see that secondary will is the lawyer who scratches out your name and puts somebody else's name on the share register. There's other value here. Many of you may have already frozen your company over time. And again, an example. I dealt with an owner manager recently who had frozen the value of their company at $10 million. But after the downturn in 2020, the company was only worth $8 million. So they actually went in and refroze those shares down to 8. They knew full well that they expected that once we came out of COVID, those things were going to go past 10 and well on to the 20s and $30 million. So it again minimized the amount that was going to be taxed in this generation's hands. So next slide, please. There's a couple of other strategies I just want to deal with here before I finish. The big benefit that most owner managers have that only a company owner for a Canadian controlled private corporation has in this country is the lifetime capital gains exemption on the sale of qualified small business shares. The current exemption is $883,384. It goes up slightly every year. Will probably eventually be capped at $1 million. But what that means is, and I'll give you a numeric example here, if I have a company that's worth $3 million, the gain on the sale of my shares is measured against the paid up capital, which is usually the $100 that I put into the company to incorporate it 20 years ago. So if I have a $3 million company and I sell it to an arm's length person and I don't use my exemption, all that $3 million is one giant capital gain. I pay tax on half of it, $1.5 million, 50% tax rates approximately. It will cost me $750,000 to sell a $3 million company. But if I can use my own exemption up, then I'll save approximately $230,000 of that $750,000. And if I'm lucky enough to have myself organized with my accountants and my lawyers to be able to bring my immediate family into the multiplication of that lifetime capital gains exemption, I could bring in 4 and be able to offset all of that $3 million gain, save my family $750,000 in the transaction. To qualify, the one thing that has to happen is we have to be sure that we have the right asset base, the right asset mix. The ratio between active business assets and passive assets. And this tax deferred advantage I keep referring to is typically passive assets. And I need to plan to get those assets either out of the company to a holding company, which is not to be sold later on, or out to my personal hands if that's the only way I can purify the company. Now, if the market is down and I'm moving these assets out, well, at least it's going to cost me less tax to take it personally, and I would then get the gain in my personal hands. If I do it intercompany, as I mentioned, to a whole company, a holdco, it's a tax deferred transfer most likely anyways. But the purification is something that a lot of people are looking at now just to see if it makes sense to purify your companies now so that in the next few years I can sell my company and get the exemption. I also mentioned about realizing capital gains. Remember here that you can get the tax-free half of a capital gain out into your hand tax-free. I'll give you some numbers on that in a second. There's also very interesting donation rules that are only available to a corporation and not to an individual. We'll show you those in a second. And if you are, charitable minded, you will want to know these if you don't already, as you'll see the results are good for everybody. So next slide, please. So this is headed realized capital gains, and it simply gives you the numbers attached to, I've got a $500,000 portfolio in my company. I sell it for whatever the reason, whether I just want to sell it because I don't like the markets or I want to do something else with the money. I'm assuming here that it cost me $300,000 to buy that portfolio. That means I've got to now realize $200,000 capital gain. Only half of that capital gain is taxable, so $100,000 at an approximate 50% tax rate. And by the way, if anyone is not aware, I keep using 50 versus that 12 or 15 earlier. Taxes on passive investment income are typically around 50%, whereas active business income gets those favorable small business rates. This is investment income that you make in your company, whether you get out of bed or not in the morning, and they have a higher tax rate because of integration. That 50% tax rate means that you pay $50,000 in total taxes, but if you remember the CDA, the tax-free account, tax dividend account, gives us $100,000, which is the tax-free half of the capital gain. We could take it out as long as the election has been filed and accepted by CRA on a tax-free basis. So again, this might be the difference between you having to go into more debt or get money out of the company on a tax-free basis. But if I add on to this example, and I say, and the numbers are not there, so this is just mythical. If I also had a $500,000 portfolio that was $200,000 underwater, let's say I also invested in $700,000 in another business or stocks or whatever, and it was only at a fair market value of $500,000. So I would have a $200,000 unrealized capital loss on that. If I did the recognition of the capital gain first, I could get that $100,000 out tax-free, and then later on in the year recognize realize the loss on the investment portfolio that's got the loss, offset the capital gain completely, and cost myself no corporate tax, and yet I've still got that $100,000 out tax-free. Next slide, please. So on the donation side, what we're going to look at now is the difference between a cash and an in-kind donation through a corporation. So you have money, maybe this tax-deferred advantage inside a company, and you are charitably minded, and you want to make a donation to your favorite charity out of the company. Well, our first column shows what happens if we had, say, a $100,000 stock position that we wanted to liquidate and give the money to the charity. Well, what we would end up doing here is we'd liquidate it. And let's say we have a $50,000 cost base. That's what it costs us to buy that $100,000 position. The capital gain is 50. We have a taxable capital gain of half of that at 25. We lose 50% of that, which is $12,500, which means of the original $100,000 security position, I now have $87,500, which is simply the tax being paid, to give to my charity. The charity will give me an $87,500 donation receipt. But I also have an addition to my CDA of $25,000 because that's the tax-free half capital gain. So my company, it's an $87,500 donation or deduction for donations. It is a deduction in a company, by the way, not like a tax credit personally. The charity gets $87,500 and the shareholder gets $25,000 tax-free. But if we donated the security in kind, let's say we've got a $100,000 position of an insurance company or a bank, and we donated the securities to the charity, they're always situated now to take that security in, and because they're not for profit, they can just sell it, get the money, there's no taxes to be paid on their end. But you've given them $100,000 worth of securities. So the company will get a $100,000 donation receipt. So now the charity has gotten $12,500 more, and the company has got $12,500 more of a deduction based on the donation receipt. But the interesting part of the donation in kind is the government essentially waives the capital gain from being taxed. So now we have a $50,000 gain, which is tax-free. So oddly enough, in this example, $50,000 gets added to my capital dividend account, my CDA. I can take that out tax-free as long as the proper elections have been done. So the result is I get 50, not 25 as the shareholder. My company gets a bigger donation and the charity gets more. So clearly, why wouldn't you do it if you were charitably minded anyways? Next slide, please. So my last point of the day before I open it up for my compatriots to finish off and give questions. At this time, both personally and corporately, there is a lot of bad debt out there. You may have, and let's just talk about this personally before I get into the corporate side. You may have lent money to a brother-in-law to start a business. And you may have taken a share in his company, or you may have just set it up as debt that he's had to repay. But his company's gone bankrupt, and you have now lost your money. Well, that is a business investment loss. So at worst, it's a capital loss, which means you can take the half of the loss and offset your recognized realized capital gains with it, even if you go back 3 years. But if it's eligible, if it's allowable, and essentially this is small business oriented, arm's length oriented, that business loss becomes an allowable business loss, which simply means you can write off that loss against any form of income. Now, it's still only 50%, but you can write it off against business income or interest income or salary, or in the sense of a corporation, you can write it off against profits in the company. So it's the same deduction, but it opens up what you can write it off against. So oftentimes this time of the year, individuals and owner managers are looking at their balance sheets to see what bad debt they have. And is it possible to recognize these losses and be able to take advantage of them on this year's tax return? So that's it. I've gone to the last page now. At this point, I'm going to pass it over to my associate Ramos, who wants to take us through the last couple of pages of this presentation.
Go ahead, Ramos, you're not muted. Ramos, are you there?
Well, so Ramos jumped on. This is Dale again. Let me just tell you exactly what he was going to say. I guess he just got a technological problem there. TD is we host regular virtual events. We just wanted to alert you to this one. This is coming up on October the 22nd at 1 p.m. It's going to be hosted by our Kim Parlee, who is a normal face on social media these days. And we'll have a partner from PwC, as well as panelists from the TD Bank. Halpern is one of them. I know very well, and a very intelligent guy, can bring a lot to the page. And Nancy King, one of our senior managers for business banking, to talk about the impact of behavioral shifts on post-COVID world. Essentially, what is happening to your customers, and what do you need to be able to change your business model to take advantage of these? We would certainly love to have anybody on this call dial into that. And we certainly will be able to get you that information. And all you need to sort of, I guess, is to put your hand up and say you'd like it. We'll get that to you. So I guess you're still not with us? Oh, that's unfortunate. So I get to the point, we're to the end of the presentation, and I'll pass it back to the folks at the Chamber of Commerce.
Yes, thank you, Dale. Really appreciated and enjoyed your presentation. And now we're going to open it up to the audience for questions. It's intended to be an interactive session, and so again, you have two ways of sharing a question, either by Slido. Raise your hand, as I think I've seen someone do, and we'll unmute you and call upon you to ask your question directly. I start off with, let's see who's raised a hand. David. David, could you unmute yourself and ask your question? Thank you. Go ahead, David. That's fine. To move then to Slido. And we have the first question. It says, I'm the regional business liaison for Fort Nelson Chamber of Commerce. My question is, are there any specific programs for Northern small businesses that they can tap into? Dale, do you have any line of sight into that?
Actually, very little. I spent a lot of time in the north with previous employees, but none with the bank. I do know that the federal government has an exhaustive website on this subject that's easily tapped into. But I'll talk back to you if you have anything more specific.
Sure. We'll be able to follow up with you. If you could just post that again, your contact information, your name, or mention that in the chat function here, I'll be happy to follow up with you afterwards and identify some resources. We have another question here. It asks, what are examples of tax policies announced during the pandemic that were helpful to SMEs? What should or could have been announced for SMEs from perspective? So dual question, Dale. What was helpful from a tax perspective this past couple of months, and what could still be helpful to a potential second economic?
Well, from personal experience in dealing with some clients in my patch of the woods, certainly the CERB helped an awful lot of, especially students, get through the summer with the prospect of being able to go back to school, whatever school looks like this year. The major landlord side, rent assistance had a tremendous effect. And, as we all know, small businesses just got slammed in terms of being able to get any top line revenue, so therefore they couldn't afford to pay rent. So the rent program simply, if the landlord waived 25% and the tenant paid 25%, the government would kick in the additional 50%. Now that was absolutely invaluable in keeping a lot of small businesses, restaurants, stores, et cetera, in business. So we'll have to see what happens if we go through a second wave of shutdowns. But those were really very good. And I can also tell you again this is a personal side. I happen to be on a couple of boards. And without the wage subsidies that were provided by the federal government and provincial governments in some cases, we would not have been able to maintain our services to our clientele. And it allowed us to actually provide the services to the marketplace that would have basically been shut down. And this is both in a public service area, a private club arrangement, as well as a charitable world, that without the wage subsidy, it just would not have survived. But those are my comments, and I guess working for the bank, I probably shouldn't step out of line, say what should have been done, and maybe I'll leave that to you, Andrew.
Great. And so, and one thing that we've often heard is that the refunding of losses very helpful for small businesses during the crisis as well. And just at the beginning, we also did notice that having flexibility on repayment of or payment of remittances was quite useful from a small business. Okay, it looks like I think David is back. David, can you try asking your question again? Your hand unmuted from my perspective.
Yeah.
Okay. Well, is there anyone else that has a question for Dale at this time? Well, let's not keep you any longer. It's always good to get some time back in our day. I will point out that in the message board here, I have put up a link for TD's upcoming webinar on October 22nd, I believe. So you can just take a look there. And again, I wanted to thank all of you again for joining us today. We know how valuable your time is, so thank you for choosing it to spend with us. Additionally, a big thank you to TD and Dale for leading this session. These conversations are greatly appreciated by the Canadian Chamber and its entire business community network. The webinar will be up on cbrn.ca in a few days if you would like to review again and contact Dale and his colleagues at TD. Again, thank you very much for your time, and we look forward to connecting with you again soon.